Good morning. It is Wednesday, November 26th, and we are about 26 minutes before the open of the stock market. It should be a day when the stock market opens higher, according to the futures. We're on a nice 3-day run this week as we head towards Thanksgiving. Had a big up day on Monday, nice follow up on Tuesday. Can it be 3 in a row? Maybe. Volumes are a little low this week because a lot of big institutional investors are probably taking it easy this week, probably calling it an early week. And today will probably be low volumes. And on this stream, we're going to go over stocks and kind of talk about the trends that we're seeing in the stock market as we head toward the open. Maybe kind of organize our thoughts on what trades we can do today, what stocks we could buy, what stocks we could sell to make our portfolios better. And it looks like Tink Odd, good morning. Mark Stan, good morning. Great to see you again. And if you would like me to take a look at a stock as we head toward the open or after we open, I'm probably going to stream for a couple of hours. Put it in the chat. And it costs $5 as a super chat. If you're a member, it doesn't cost anything beyond your membership. If you would like to become a member, I provided a link in one of the chat messages I put on. Take a look if that's something you'd like to do. All right, so what's going on with the market? What are we expecting is going to happen? Well, yesterday, something interesting that occurred was you saw that NVIDIA did sell off while others in the same space, Broadcom, rallied higher because they are in partnership with Google. And the Google chips for AI inferencing are being well accepted, and other businesses are looking to get them. And I'm not sure if it's because of the scarcity of NVIDIA GPUs or if it's less expensive, better, less energy to run them. But the reality is that yesterday, Google rallied higher as well as Broadcom, while AMD and NVIDIA were sold off. It created, I think, a good opportunity for NVIDIA, for people that want to buy NVIDIA. The stock was down close to 7%, which was overdone. And it did pick itself up from the low point yesterday. So it became a nice little opportunity for anybody who was willing to jump in. I certainly did. I bought some NVIDIA stock and I made more than 3% in the day. I'm not a day trader, but it just looked a little overdone. And NVIDIA had been on a sell-off. So the pricing on NVIDIA became acceptable, and I jumped in and bought some shares. It's a small position, nothing big. Other things that are happening, Meta has had a couple good days of going up. I think the troubles with Meta are behind it. Investors were upset that they were spending so much darn capital, didn't have much to show for it. And I have to imagine that the leadership over at Meta got the message. Don't overspend on capital, and then your stock will go higher. The other thing I'll mention on Meta is the business is growing really well. Business is growing 26% top line, showing that their social apps are just growing. They're very popular with people. All those things apply. So the business is fine. And in fact, kind of one more bright spot for their business is the whole Meta glasses have been incredibly popular. I think those are going to become a material business for Meta, and it's going to be one more positive element to the Meta company. So we'll see where that goes. These two are my biggest positions, so I'm okay when they go higher. Amazon caught a bid yesterday. The finance space caught a bid. That looks good. And healthcare. Caught a really nice bid. All right, looks good. Now let's take a look at, before I look at the list of the biggest, most valuable companies, let me take a look at the chat. And good morning. Zubio, nope, not selling. Google, good to see you. Thanks for joining. Magical Self. What am I planning on buying today? Well, I do have a pretty good list of stocks that I am a buyer for if the pricing's right. Why don't I give it like 45 minutes? The stock market opens. We'll see where stocks are trading, see what the market is really going to do. And I could tell you what looks like a good buy for me. And so I could answer that question, I think, more completely once the market opens, because right now the market's closed and I could do a pre-market order, but I don't like doing that, carte blanche. So we'll take a look at it in about 45 minutes. I'll come back to that. Let me make a note of it so I don't forget. All right. All right. So I wanted to look at the top most valuable company list because it's been changing. Nvidia touched 5 trillion. It's come down, and the pricing's come down on the stock to the point where I thought it was a good buy yesterday. I bought it and it rose from there. If it sells off, I might buy some more shares. So we'll see where it goes. Apple, I'm not all that excited about Apple. I'm not an investor, and I think their lack of growth shows that long term, I'm just not sure how valuable this business is going to be. They have been squeezing as much value out of that single product, which is the iPhone. They've been very successful in doing that. But what's next? As opposed to Google Alphabet, there's lots of things that are next. They have the search business, which is awesome. But next is YouTube is growing really fast. They have their cloud business is doing great. Their AI business is doing great. Their robo-taxi and Waymo is doing great. So there's lots of things that are really exciting, which is why this stock is up 70% year to date. It's the top performing stock out of the top, looks like 16 companies that are the most valuable companies. And this one has risen up the ranks. It took over the third place spot from Microsoft. I think it took over this week and it flew up. Microsoft's been kind of just hanging on to a modest gain, keeping up with the S&P, but not much better. I think it might be a tad bit behind the S&P. So Microsoft, I think, is fairly priced at this time. I'm not overly excited with Microsoft. I'm more excited about Google. This is my biggest position in my portfolio. I had the best confidence in them. And I should phrase it as 6 months ago, when the pricing was awesome, I had a lot of conviction behind Google Alphabet, and I bought a lot of Google Alphabet. So now that the pricing's higher, I'm holding. And, would I buy if there was a sell-off? Yeah, if there was a good dip, I would buy Google Alphabet. But for now, I'm just going to hold on. I am buying Amazon. I don't own as much Amazon as I own Google. And I think that company is being misunderstood and underestimated. I think Amazon's a very powerful company that has really valuable businesses. And if you guys want, I could analyze it on the stream. I'll let you guys tell me. But Amazon's a terrific business. Broadcom has been growing really fast. It does have an expensive price to earnings ratio. I do think this stock is expensive, but that's my opinion. I owned Broadcom for some time. I took a gain and sold the stock. Meta. This is a stock that's been beaten down. It's only 8.66% year to date. But I think this stock is going to go higher. I think this was my pick yesterday on the stream. I was asked by a member what stock I thought would do the best between now and the end of the year, and I actually answered it with 2 stocks, a major cap the best major cap between now and the end of the year, I think, that I could hold and buy is Meta. I own a lot of Meta, so I'm in. And then the small cap stock that I thought could really go higher is eToro. So those are the two best guesses, educated guesses that I put out there. Tesla, I don't have a lot to say about Tesla. I'm a fundamental, analysis investor, and the fundamentals behind Tesla just are not even close to where the stock price is trading. A 289 PE for a car business, and even for a technology business. Look at all these technology businesses up here. They have PEs at 30, 32, 34, 37, 44. And these are technology businesses. This is 289, and they're a car business. Some people might call them a technology business. They don't have the margins to be a technology business. They don't have the margins that NVIDIA has. They don't have the growth that NVIDIA has, but they have a PE ratio that's extremely high. So that's somebody else's investment. I'll let them either succeed or fail with Tesla. I will not invest in that company. I am investing in TSM. TSM, their pricing's come down over the last month, and it's a good company. I've owned it before. I owned it for years, did really well with it, and sold it. And now I've started a position again, and so far so good. So TSM looking good, and they are the world's foundry. That's where most of these semiconductor companies, they design the semiconductors, then they go to TSM and ask them to manufacture them. Berkshire is up 12.2%, just slightly below the S&P. Eli Lilly is really doing well, up 43%. This is the biggest market cap pharmaceutical company. Walmart, I'm skeptical. What is Walmart doing on the list? This is a retailer, not a lot of margins. They're not growing really well. I just don't see why I would ever invest in the company, but if somebody else is an investor and has been successful with it, congratulations. And I'll stop there. Those are the biggest companies, and that's what's happening at the top of the food chain. All right, so magical self. So the position I'm trying to get to with Amazon and TSM, that's a good question. So I'm going to cover that. Jump into that. Let me just look at what earnings came out, and we will get into that magical self. Okay, so earnings. Yesterday, we had some interesting earnings from Alibaba. Now, the live stream went really well. A lot of good questions. And I had planned to look at Dell, Autodesk, Zscaler, and didn't get a chance to. That's fine, because some really good questions came up. Today, we had Deere, which is the big, machinery company, announce Li Auto in China. That'd be interesting for me to see, because I think China is making a lot of good products, especially cars that we don't see here in the US, but they're sold internationally. So maybe we can go back and take a look at those. All right. So let's get into Amazon and TSM. And okay, so Amazon looks like it's going to open higher in about 12 minutes. And this stock, really for the last 5 years, if you compare Amazon against Google or others, like they have not performed up to the level of these big cap, technology oriented companies. Amazon's an e-commerce, cloud infrastructure, and other businesses like their Prime business, video streaming. They do the football games on Thursday nights. So it's a it's a diversified business. And the reason why I'm very positive on Amazon is their e-commerce business is much larger than anybody else in the space, and they continue to grow it. Their cloud business is much larger. Their cloud infrastructure business is much larger than anybody else and continues to grow. And their other businesses are good. They're not number one, like their streaming platform, Prime Video, is not as big as Netflix nor YouTube, but it does a good job. And they do advertising on that, as well as advertising on their e-commerce platform. Their robo-taxi business is, I think, probably in second place in the US, well behind Waymo from Google Alphabet. But the two main businesses where they have very high levels of power and barriers for entry due to their network power being so darn big is with the cloud infrastructure business and their e-commerce business. This is a big cap stock, 2.46 trillion with revenues of 691 billion. Now, what's amazing is it's that big and it's growing by 11%. Okay, that's in the last quarter, 13.4. So just to put the magnitude of growing 13% on a close to $700 billion number, you're talking about $91 billion of revenue added to the top line each year. 91 billion. 91 billion is a very large business in itself. That's larger, as an example, that's larger than all of Uber. That's larger than all of most businesses, frankly. So they're adding like a new business to the overall enterprise each year with their growth. Their growth also says that e-commerce, Amazon, as an e-commerce play, dominant. I get to my home, and I'm sure many of you are in this boat. I get, 5 to 6 packages delivered to my home each week from Amazon. Their cloud infrastructure business, for all I know, Stock Analysis is running on AWS. So many businesses run their platforms, their software, their websites, their applications on AWS, which is Amazon Web Services. So that's one of the things that shouldn't be lost with Amazon. Culturally, Amazon has been a company that has never been about, hey, let's polish up our fundamentals to make our stock go up. They've always been, let's make our business as good as possible to generate future free cash flows. Let's be obsessed with our customer. Let's be obsessed with the inner workings of our business to make ourselves stronger, better, grow faster in the future. And at times that is, it hurts the stock price because the fundamentals, the metrics that investors use don't look as good. So I understand Amazon, I understand their culture and appreciate it. That's the Amazon that's been around for the last 30 years. It's not changed. They do not run their business to make the stock price work. They run their business to become the biggest, which they accomplished in e-commerce, to become the best, which they accomplished, to be obsessed and do it better and better. For example, in their operations for the warehouse, they have over 1 million robots in operation. So talk about physical AI. They're doing it. They're not talking about it all day long. They're just doing it, which is really impressive in my book. Now, so sales growth is there. That is really impressive. Historically, they generate very good free cash flows. When we look at the forecast, we have 47 analysts covering them, and they believe on average, Amazon is discounted by 22%. And when we look at the forecast that 72 analysts are putting together for next year. It's a lot of analysts. My confidence in these numbers is very high. They're going to grow 11%, 11%, 12%. They're going to be a $1 trillion revenue company in 2028. That's going to be incredible. Their PE ratio is going to drop down to 18. It's not going to drop down. Stock price is going to go up. The stock price is going to go up like 60%, 70% at least. When I see this, my conviction is very high with Amazon. Again, knowing the business, knowing how they operate, knowing their dominance, which is why I want Amazon to be a very big position. To answer your question, magical self, is position size. So Google, as an example, is, pretty big position. And in a portfolio, Google Alphabet is roughly 8 to 9% of my portfolio. And Amazon will be 7-8% of my portfolio. It'll be a big position. Okay. Why would it be a big position? It's a very well-known company that I think will do better than 100% rate of overall performance, appreciation, and dividends over the next 5 years. Their reliability is there because so many analysts are covering the stock. I've been covering the stock for years, so the confidence is there. That's why I'm willing to put so much capital into it. It'd be different if they were a small company, not as much history. All those things come into that decision of position size. So position size for Amazon is going to be huge. So that answers your question on position size. And I'm going to give you a look at Amazon in my valuation of the company, and then we'll move on to TSM. And I know Mike's on. He's got some questions that I'm going to get to. All right. So I think Amazon's discounted by 30%. I've been buying Amazon. This has been the biggest investment that I've made in the last 3 to 4 months. Now that Meta has been reduced in price, I'm also buying into Meta very quickly. And I think it's going to work out well for Amazon, for me as an investor in Amazon. So let's talk a little TSM. Taiwan Semiconductor, this is the foundry to the world. And I think it has a modest discount, but boy, semiconductor's been a bottle rocket of appreciation. It's just gone up and up. And it's recent that we've seen a pullback, and it offers up a nice little discount. So let me take a look at TSM from a company perspective, and then answer so I think it's discounted. Analysts believe it has a higher discount than I do. Only 3 analysts cover it, not a lot of coverage, which is interesting. It's a really important company, and analysts are not really putting a price target out there. They are putting 39 analysts are putting their forecast on growth and so forth. The growth looks terrific. This is in the Taiwanese currency. That's why you're seeing trillions. And but the growth is excellent. So the growth looks good. Overall, TSM, I think, is a very good investment. The discount isn't outrageous. It's okay. And what would my position size be for TSM? So position size would probably be maybe 2-3% of my portfolio would be the upper limit. And I'm at a dollar cost average on all my investments. I dollar cost average, but into the position in Taiwan Semiconductor, it would be about 2-3%, which would be roughly about $25,000 to $40,000 as an investment, and let it kind of operate for a couple of quarters, if not a year, see if the fundamentals are improving or getting worse, and then make decisions at that point. So that is TSM, and what I would do, or what I plan to do, because I own both Amazon and TSM. So thanks for asking about that. All right. So how you doing, Mike? Good to see you. Good to see you on the stream. And you're heavy in UNH and ELV. Well, the one thing I would say about, I own UNH, as you know, and I own Oscar Health. I view Oscar as being very different than UNH and ELV in this way. I think UNH and ELV are very similar. UNH is larger. I would argue that it has a little bit better brand recognition, a little bit stronger brand. It does come with some news at the end of 2024 that was very, very rough, with the CEO getting assassinated. But overall, that's where we are with UNH and ELV. It's like Coke and Pepsi. They're similar. So if I owned both, it kind of feel awkward for me as an investor. I'm like, I should pick one horse and ride it between the two. Oscar is very different. I don't view Oscar as being like UNH. First, they are in the same industry, health insurance, but Oscar is going after a very different market within a very large ecosystem, right? Oscar is looking to get insurance for individuals and small businesses. UNH is going after big corporate customers that have 100, 200,000 employees. They sign them up and they provide health insurance for all those employees. Oscar is in a different model. So Oscar, I think, has much more volatility and risk, but it has incredible upside. Oscar could be a multi-bagger opportunity and really reward investors. I could be sitting on a 4x, 6x, 10x return over the next 5-10 years with Oscar. I don't expect that from UNH or ELV. So for me, I own UNH. You know that. It's a pretty big position, about, I'm going to call it 3 to 4% of my portfolio. I don't own ELV. I used to own ELV. I sold ELV to buy UNH. And before that, I mean, I'm going back like 15 years. I owned UNH for a long time, made money on UNH, made lots of money on UNH, sold it, and then bought ELV. So I'm not in UNH or ELV at the same time. So that's how I invest in healthcare. Considering moving Oscar funds equally to CRM, Monday.com, Meta, Adobe. I shared my comments on Oscar. I'm not getting out of Oscar. What's Oscar doing this morning? And I see a super chat. I'm going to get to that super chat. Give me a second. Oscar Health. What's wrong with making money, Mike? 7%. Let's keep going. Let's keep going, Oscar. In the last couple of days, you've gone from 13 to close to 17. And this stock, it has it has the track record of really going high. And at one of these days, it's going to stay high. It's going to get up to $30 a share and then stay north of $30 a share. And I want to be around for that. I mean, look at that terrific 7% gain today. On the flip side, UNH, good gain, 0.7, not bad. And ELV down a little bit, not too bad. But you see the difference. Oscar is going to be a roller coaster. Do not watch Oscar too close, because it'll drive you crazy. You just got to set it and kind of manage it. Look at the earnings very closely. Research every big headline that you see. But look at that, up 8-9%. Nice work, Oscar. From a percentage standpoint, as you could guess, this has been the best performer in my portfolio for November from a percentage standpoint. I own a position in Oscar that's maybe 1% of my no, that would be, yeah, about 2% of my portfolio, which is a small position as opposed to UNH. I own 3, 4, 5% of my portfolio, about just a little shy of 100,000 in UNH. Oscar, I'm at 30,000, probably gaining a little bit more now with an 8% rise. So good luck with your decisions there, Mike. Thank you for joining early this morning. And all right, Anderson Tolentino, thank you so much. I've seen you a couple of times. Thanks so much. That's very generous of you. Thank you. And I'm glad that coming on our streams is helping you. I can tell you firsthand that, I have been investing for a long time. And for a long time, it was kind of a solitary experience because I come out of a family where I'm the only stock investor in my, brothers, sisters, and cousins and so forth. And became an accountant through education, corporate accountant, controller, then went into the software industry, got a master's in business, really loved mathematics and modeling. And so I would do this stuff and I would read about, the great investors, and I would invest, and it'd always be a very solitary experience. This is like 25 years ago and so forth. And then, of course, the internet, YouTube and stuff. So I found myself watching YouTubers and going on live streams and really enjoying that. Hey, there's other people that really get into analyzing companies, investing in stocks, and making money on stocks. And really, when you read the books on Warren Buffett, Peter Lynch, and even more recent Pat Dorsey, and you see that these investors really accumulate wealth through stock investing, and it's this. I think of stock investing as a lifelong passion. Charlie Munger is an example. He was 99 and he was still investing. Isn't that phenomenal? First, he lived till he was 99, which is phenomenal, and he amassed a fortune. And that's a real awesome North Star. Okay, and so back to you and your experience, and everybody is, it is a lifelong kind of passion you could have that's going to be rewarding, short term, long term. You get better year after year, and I think it could be a funner experience, a more interesting experience if you've got others of like-minded that get to talk about stock investing, like Mike, the dividend investor guy. He and I have been communicating for well over a year now. And I've gotten to know his stock investing style, what he wants to do with his portfolio. I enjoy hearing about what he's doing. I hope he feels the same way about the stuff that I'm doing. We're not carbon copies. We're not like copy and paste. He does his portfolio differently. He buys and sells using his skill set and the way he likes to manage his portfolio. I find that fascinating because I'm a learner that I'm willing to read the textbooks, love the textbooks, and love the lessons that teach me the fundamentals. Like mathematics, you can't learn mathematics without learning textbook mathematics, right? But putting it into practice and learning from others has always been a lifelong, accelerator for my learning. When I see other people do it, I learn so fast. I learn from my peers. I learn from others. I learn from YouTubers. And I hope you have that type of experience to accelerate your skill set and your success in stock investing. So I appreciate you attending, and I appreciate the super chat. You want to take a look at Mercado Libre. and I would love to look at Mercado Libre. I think it's been an opportunity recently. Give me a few minutes to check the chat, and I will be on Mercado Libre. Mike, the dividend investor guy. Yeah, it's, ELV, and, we've been talking about ELV and UNH for a while. Just ELV is not going to be UNH. UNH is like Coca-Cola, and Pepsi's pretty damn good too, but it's not as good as Coca-Cola. It's like the number one brand in health insurance is UNH. And that's the one that I'm going to put a lot of capital into. I wouldn't, as mentioned, I don't hold ELV. Herdo, my man, how you doing? Yeah, it's awesome to have you. And you're a regular giving me super chats. I really appreciate it very much. Thank you so much. Let me know if there's a topic, stock you want me to cover. Cool. That's great that you have a master's in finance. It's great. And I don't think you're a member. If you become a member, you get the model that I use that you'll see often as I analyze the stock. And I'd be curious to see if you can look at the formulas. And a lot of those formulas are straight out of, the finance that investors use to analyze the value of a stock. Well said, Mike. Thank you. Bo, regular Bo, how you doing, man? Always great to see you. You were on the live stream last night. Thank you very much. Blocks for fun. And, I can't look at Oracle for reasons that I could share with you privately. If you want to reach out to me, I could tell you why, but I cannot look at Oracle. And then Mark, thank you so much. I appreciate it. Thank you, sir. And Robinhood is going up, is it? I'm a big Robinhood investor. What's going on with Robinhood? Yeah, it's going up nicely, very nicely. All right. Thanks for the tip there. And Robinhood's been a big success story. Herdo, let's take a look at HIMS. HIMS has been looking better and better. It's been really settling down. Let's take a look at, we're going to look at Mercado Libre, and then we're going to look at HIMS. Thanks again, Herdo. All right, so Robinhood's going up 8%. It's had a good week, I think. Yeah, real good week. And when the market goes up, Robinhood has a good day. And Robinhood's also really connected to crypto. So crypto, the Bitcoin's at 87,000. And that's okay. It was at 124 like 4 or 5 months ago. So that's where it's at this morning. Looking at the stock market as a whole, the S&P is up 0.46, NASDAQ 0.45, and then the Dow is up 0.6. Taking a quick glance at the heat map, NVIDIA is coming back. It's in the green. It looks like AMD's in the green. Some of these semiconductor stocks that sold off yesterday were in the red. And then we've got Palantir up. Okay. UNH is up nicely. We saw Oscar was up. Energy's up a little bit. Consumer staples are up. So it's kind of a mixed day. We'll give it a little bit of time to see what the market's going to want to do. Google's selling off, Meta's selling off. They've had a very good couple-day run. For me, it would be, I'm going to buy some Meta today. If it's down like this, I'm going to buy some Meta. I'm going to see about buying some Google. What other things pop out at me? Fortinet's down. I'll take a look at that and see if I want to buy more shares. I own Fortinet. CRM is down. I've been accumulating some CRM, but it's not a big position. It's 1% or less. ServiceNow is this whole software space. The market just is not buying software companies, and that's that. So that's going on there. All right, so let's get into some stocks here. And before I do that, good morning, Fallsgrave. Yeah, so that's a very good compare. Eli Lilly versus Novo Nordisk. Got it on the list. And it's an interesting situation there where one is the favorite to the stock market and the other is not. We'll get into it. I'm glad you asked about Marvell, DJ. Good to see you. Because I've been keeping an eye on Marvell. Marvell was part of a best and worst semiconductor stocks video I created in the last 30 days for members. And I've been keeping an eye on it. Seen what it has going for it, because it really sold off harshly, and while the data center stocks have been flourishing. So more to come on Marvell. All right, let's talk about Mercado Libre. And Mercado Libre is an e-commerce company down primarily in Latin America. Brazil, Mexico, Argentina. They also do fintech by providing services for people. They are a pretty good size cap, 103 billion. Year to date, up 20%. But you see this real decline that we've seen since the May timeframe, and it's really given us good pricing. I'm a Mercado Libre stockholder. That pricing to me looks really attractive. Now, let's go through kind of like the important aspects to a business that I like to look at and assess, is this a good investment or not? So first, the PE ratio is high. So we're going to look at their sales growth and see, is this PE ratio reasonable, or is it just priced too high? Analysts do believe there's a discount. So let's take a look at their sales growth. Are they growing really fast and really impressing the market? The answer is yes. They're growing very fast. In the last quarter, they grew by 39.48%. And looking at their business, this is in US dollars. This is a pretty good sized business, $20.7 billion in revenue. And when you're growing it by 37%, that means you're going to double your business every 2 years. So you're going to be 40 billion in 2 years. You're going to be, if you keep growing at that rate, you're just going to get bigger and bigger. So that growth rate shows me customers really like Mercado Libre. They like the products. They like the assortment. They like the financial services they provide. They really like Mercado Libre. The revenue growth gives me evidence that is a fact. Customers like it. If it was going down or decelerating, it'd be the opposite. Customers do not like Mercado Libre. They like somebody else. Now, a quick, I would say, note that investors might quickly say is, well, Amazon's going to probably go after that market. And the fact is that they tried, but they've been trying for 15 years without success. Amazon's been trying to go after the Latin American market for 15 years, not been doing so hot. Why is that? Well, as one could imagine, there are cultural differences between the US and some of these Latin American countries. The assortment of products, the way you communicate to people in Latin America, the way you approach the market, those things really do matter. And Amazon, although they're awesome in the US, they don't have the ability to connect with the customer in Latin America the way Mercado Libre does. And the proof is in Mercado Libre's growth. And the proof is that Amazon's been trying for 15 years without really disrupting Mercado Libre. So if you just look at the scoreboard, Mercado Libre is fending off Amazon. It's not a threat. So when we look at analyst coverage on this stock, we've got 18 analysts covering it, believing that the stock is highly discounted at 40%. With that's pretty good discount. Let's take a look at their forecast. So we have 24 analysts putting their forecast on revenue 2027, and they believe the company in next year they're going to grow at roughly 27%, 22% to follow, and then 20% in the third year. It's very good growth. The profit is going to expand fast. Okay. And forward PE is going to drop to the teens, but I don't think it's going to drop. I think the stock price is going to go up and keep that PE ratio nice and high as this company continues to perform really well. One other thing about their market, I think the Latin American market has a lot of people that are new to buying online, are new to having a full PC and buying stuff on a phone, buying stuff on a PC and so forth. And I think that in itself provides organic growth. And the US, I would say, is a very mature market for e-commerce. I think most people have already experienced buying on e-commerce platforms. All those things are fine. So I think Mercado Libre does have a market that is where they can grow a little longer, a little faster. And that is one thing that I believe is the case. When I look at my valuation for Mercado Libre, let me show you my discount. There's a 53% discount available on Mercado Libre. A couple things I'll point out. I'm using a 9% discount rate, where Amazon I have a 7.5 discount rate. Higher discount rate because Mercado Libre is operating out of my home country, down to Latin America. Just as soon as I invest outside my home country, the discount rate goes up. Whether I'm investing in TSM, Mercado Libre, or Novo Nordisk, which is in Europe, ASML. ASML is awesome, but a little bit higher discount rate because it's out of my home country. Even though I use a higher discount rate, which should get us to a lower valuation, it's still highly discounted. I have a discount higher than the average that analysts have. The analysts were at 40%. I'm at 52. Their cash flows are excellent. The way their ability to generate cash is very high. And you think about their business, right? It's not like they're, buying expensive real estate, developing it like a McDonald's, and then you have to put a lot of capital. No. The other thing that these e-commerce companies are doing is they run the platform, but their partners are buying the inventory, putting it on the platform, and then selling it. And then Mercado Libre or Amazon are making money. Alibaba does the same thing. So they don't have to carry a lot of inventory. They just have the platform, then people sell on the platform. So they're a little bit like Visa, where they're charging a toll for you to sell on their website. Very attractive business to me. I like the business. I own Amazon. I own Mercado Libre. I own Alibaba. Now I'm covered for e-commerce, Latin America, US, Asia. Got it covered. So Mercado Libre definitely is a buy for me. And looking at where the stock is trading today, I'll probably pick up some Alibaba today. So that's my review of Alibaba. Let's move over to HIMS. So HIMS is categorized as a healthcare company. They do generic drugs. I think that's well put. And they do it in a way where they're providing kind of a club program or a program for specific conditions, for specific issues that people want to address. So they're going after the most popular issues, weight loss being one of them, hair loss, and so forth. Now, the 1 year, this stock has been places, right? Overall, it's up 20%, but you see that it's really sold off. Now, the thing about HIMS, it's still relatively a small cap. And if you look at the 5-year, it would have been a really good idea to buy and hold HIMS. At times, it looked like a genius move, super genius, and then a month later, it kind of crashed down a bit. So that's a little bit of what you're signing up for when you invest in a HIMS, and to a lesser extent, Oscar Health. But let's talk about HIMS for now. Small cap, decent revenue. You're buying the business for about 4 times revenue. And the PE ratio is high, but we'll look at revenue and see if it's rational to expect a high PE. So let's take a look at their growth. So very good growth for the full year, very good growth for the quarter. Now, the growth is decelerating a little bit, but it's still very, very good. Fantastic growth. Okay. What's also impressive about HIMS is not putting a lot of money into drug discovery and things that consume a lot of capital, a lot of investment. They don't do that. They are going after things that already are created, are known. They package it and then market it to the market. So they do spend quite a bit on marketing and selling expense, but they do have very good margins, 75% gross margins. But you see how the profit really drops. That's because their selling cost is really high. They are spending a lot of money online, advertising HIMS, so that they can get more eyeballs on the products they sell, and they get more clicks and then get more revenue. It's just expensive to acquire customers and keep customers. So that's part of the business that they run. Their cash flow is decent. It has been going down if we look at the quarterly. Let's look at the full year. This is the trailing 12 months, so that does give us a good number. So the free cash flow trailing 12 months for the last 12 months is 133.9 million. They have a good balance sheet if they haven't moved far from the last time I looked at them. And they have a little debt, $1.12 billion of debt. Free cash flow, 629. So they have about $500 million of debt. Debt to EBITDA is 6.29. I don't know that I agree with that. So they're a $2 billion revenue company, $500 million. Y'all have to look at that closely. I'm not agreeing with that number. I think their balance sheet's fine. Looking at the analysts that cover the stock, we have 9 analysts that cover it, and there is kind of the price targets are spread out. You have a price target at $30 a share, price target at 85, and on average discounted by 18%. See the forecast, how many analysts are participating in it. 17. That's a very good number. And the business is, more certainly boomed for the last couple of years. It's going to get into this good growth rate, 19.43% for 2 years, and then really slow down. If this slowdown's real, HIMS is going to have like possibly a good year, but then probably see its stock price have a lot of problems, because if investors start looking at a slow growth company that doesn't have patent protection, that doesn't have a lot of the other things that pharma companies have, they are going to contend with some legal issues with Novo Nordisk going after them for weight loss, then it might be a little bit of a risky issue. Now, can this stock be a good short-term success story? Yeah, because it's been proven that this stock's really shown that it moves very quickly, and it could go up really fast and then come down. But we are catching it on a low point with a small rally behind it. But you see how, man, you could swing trade this puppy and make good money, buying it at 40, selling it at 60. Nothing wrong with that. So that would be kind of like the idea I would have on HIMS is it looks well priced, and I'm going to do a valuation on it right now to confirm that. And it looks like you have the possibility of it going up from, we're priced at 37.80. It goes up. If I bought HIMS, I would probably set my exit strategy, sell it when it gets to $50 a share, sell it when it gets to $55 a share. And if it hits that number, sell, even though it might go up higher, because it does this. It goes up, comes down, goes up, comes down. So, and as we approach that 2028 growth number, if it stays with slow growth, if they don't come out with a new category of sales, then this is a stock that's probably going to struggle to go higher, because the market's not going to be excited by a single digit grower of this type. It's just not. So that's where I'm at with HIMS from how would I invest in HIMS? So let's take a look at HIMS and update what the valuation is. I think hasn't been updated for a while. All right, so HIMS, I'm going to change the discount rate. I'm still going to go to a 9. It's a small cap. They are mixing it up with some really big pharma companies like Novo Nordisk. What I mean by that is they are stepping into their marketplace and creating noise. And Novo Nordisk doesn't like that noise. So, so their free cash flow was going down, which is not good. And I think it's because they have to spend so much money marketing their product. So their free cash flow isn't as high as I would like, but it's still a good forecast. Okay. And when we look at cash, they had, I think it was 600 some odd million. Let me take a look at that in another screen here. Yeah, 629,740,000, and then $1,120,000,000. So the cash flow doesn't look great. So the growth looks good. Gross margins look good, but they have to spend so much advertising and so forth that it doesn't leave a lot of cash. So that number doesn't look good. Earnings per share, let me look at that number. Look at the forecast and see where earnings per share is going to land. 81 cents. They are growing stock, so 36. I'm good with that. This should be about a 20% growth. So HIMS is not priced attractively enough for me. It's it'd be a pass. If it was priced at a discount, maybe I'd go for it. But I'm good with Oscar Health. I think Oscar has a clear idea, which is we'll sell health insurance to individuals and small businesses. There's no big company doing that right now. They can really carve out a good portion of the market, which is a big market for healthcare, and then stick to it and grow for the next 10 years. That's great. HIMS doesn't have that story. HIMS, as the forecast shows, they're going to keep growing for a year or two and then struggle to grow. That is not a great story. And they're not discounted right now. Their cash flow isn't high enough because they spend so much on advertising. So that's my review on HIMS. I started off optimistically thinking maybe that's a good buy, but once I got into it, it shows that it's having some problems, and the fundamentals don't show that the stock is valued high enough. All right, so let me make myself a note. All right, let's move on to Eli Lilly and Novo Nordisk. Before I do that, let's see what's going on with the stock market. So it's fading a little bit. It's coming down a bit. And when we look at the heat map, we're seeing a stronger sell-off of Google and Meta, as well as software stocks. The healthcare space has lost some of its green shine and turned it a little red. NVIDIA is a little higher. Broadcom's been on a tear. AMD, Micron. All right. Consumer staples picking up a bid. Investors are rotating from some of these high flyers, some of these high appreciating stocks into real conservative stocks. All right. So let's get into Eli Lilly, and we'll get into Novo Nordisk, and I'll show you both valuations. I have both companies. I've studied both companies. I'm currently an investor in Novo Nordisk. I'm not an investor in Eli Lilly. And I think when I show the fundamentals, I'll explain, how I ended up being a small investor in Novo Nordisk, tiny position at this point. And I'm willing to buy. I'm willing to dollar cost average into the stock. So Eli Lilly is a very big cap, 990 billion. It's down a little bit today. Revenues, 59.4 billion. Its P ratio is high, 54. Current year, 35 next year. Analysts think it's gotten a little expensive because it's had a terrific year, and it's had a terrific 5-year. So you're not picking up a stock that, just high level looks like it's been kind of beaten up and priced down. Now, that price appreciation to an extent is well deserved because of its growth. This is the full year. Let's look at the quarterly. The quarterly looks fantastic, 53.86%. So the growth rate is really, really good. As we look at other fundamentals that I like to assess, free cash flow and margins. So margins are very high. This is a pharmaceutical company. Pharmaceutical companies carry high margins. Profit looks great. Free cash flow yield looks okay. Now, the free cash flow has grown quite a bit. And I'm going to note their free cash flow, which is $9.272 billion of free cash flow. All right. And let's take a look at their balance sheet, see if they have any debt, and if they do, how much. So they do have $42.5 billion of debt. They have some cash, $9.9 billion in cash. All right. And their debt to EBITDA is 1.47. They're a big enough business where that debt isn't all that big. If debt to EBITDA is below 3, we've got no problems. It's a manageable level of debt. And that's what the case is here. So that's not going to scare me off and point to a company that has too much debt. Now, when we get into the analyst price targets, you do see a broad range of targets, $700 to $1,500. So there are some analysts that are skeptical, some analysts that are optimistic. Overall, they believe on average it's priced about 4.5% too high. Looking at their forecast, 26, they're going to keep growing at 18.6, then 15.7, then 14%. Their PE ratio should come down into the 20s in a couple of years and stay there, mid-20s. Okay. and profits should increase. So let's take a look at my valuation. These guys are saying that on average that the stock is priced 4.5% too high. One second. Here we go. Okay. So let me update my valuation, trailing 12 months. So I have that correct. I updated this in November, so I'm good. So Eli Lilly is priced way too high. I'm closer to the analysts that were skeptical at $700 a share because it's a good business. It's just the stock price is too high. The free cash flow, if I grow it by 17%, which is rational based on their forecast, it's going to get me a good valuation, 416 billion. But then I have to take away the debt that they have. I get to 383. Their market cap, this is a little off. Let's see if what's going on here. Should be a tad bit under. So my Google lookup isn't getting it done today. But it's still basically priced too high. On the earnings per share, let me double check that number, see if I've got the right earnings per share number. And for 26, it should be $31.09. Yep. And they're going to grow, by 18% and 15.7%. So 25 is where I'm willing to go. And that's priced too high. So analysts think it's priced a little too high. I think it's way overpriced. And if they start to slow their growth, we're going to have problems. Okay. So Eli Lilly is not a buy for me. It would be a sell. And that's where I'm at with Eli Lilly. But let's compare it to its peer, which is Novo Nordisk. Novo Nordisk's a very different picture. It's discounted by 54%. And the reason for it is these two stocks have been going in opposite directions. One stock's been going north and one stock's been going south. And when we go to the 1 year, I thought I was going to compare, but I did it wrong. User error. Here we go. So over the 1 year, you got Eli Lilly 40% higher. Novo Nordisk down 54%. Novo has been kind of a disliked stock by the market. Now, I'm okay buying stocks that are disliked, taken out with the garbage because the market just doesn't like them anymore when they have terrific fundamentals. And that's the story with Novo Nordisk. When we look at Novo Nordisk, let's take a look at their fundamentals. So Eli Lilly was roughly $1 trillion in market cap. This one's 200 billion. So it's 1/5 the market cap. This is $49.5 billion in revenue. Eli Lilly is $59 billion in revenue. 59, 49. So you're paying 5 times more for Eli Lilly, 5 times, and you're getting 20% more revenue. Okay, so that I think that shows that Novo Nordisk might be an opportunity. P ratio 13. I'll use the forward PE. 13 versus Eli Lilly is at 35. So Eli Lilly, you're paying 3 times the PE ratio versus Novo Nordisk. Dividend looks good. And again, we saw that the stock's really sold off. Now let's take a look at their growth. Their growth has been good. I would say not as good as Eli Lilly, especially the last quarter. What happened, guys? Let's circle the wagons. Let's figure this thing out. You have to start growing. but they've had some growth problems recently. They had been growing really well. They have to start growing. Let's take a look at their forecast. Three analysts cover it, and here we have analysts ranging from $46 a share to $70. They do believe it's discounted by 11.49%, and the growth is going to be slower according to this forecast. Okay, so slower growth, but it's a very profitable entity, high margins, high cash flow. I kind of skipped over that, but the margins are very high for Novo Nordisk. We look at their margins, 83.4%. Terrific. Their free cash flow rate, better than Eli Lilly. So very, very profitable. Okay. And recently we've seen the stock really move because there was some news on, they had this new drug they were trying to invent, and they got some bad news over it. And it was kind of a moonshot drug. It wasn't something that they'd been forecasting they were going to get. And that news drove the stock down. And then like a day or two later, they got positive news on a drug. So then the stock went higher. So this stock, I think, is an opportunity for a value investor. It's an opportunity for me, and I've been buying into Novo Nordisk because I think it can't get any lower, but it can go much higher, especially if it becomes a dividend investor play. Pays 2.5% dividend. It has solid numbers. It has drugs that are in need, that are really effective. And overall, this is the play that I have. I am a buyer of Novo Nordisk, and I'm a seller of Eli Lilly. Eli Lilly is just expensive, really expensive stock. So that's where I'm at with the Novo Nordisk versus Eli Lilly comparison for this investor. Hopefully you found that interesting. Thanks for asking about that. I think that was Fall's Grave. We're going to move to Marvell, and just checking the chat. Good to see you, Tink Odd. So keeping an eye on Dave. What is going on with Dave? Dave, we looked at in the live stream last night. Look at that. It's up a little bit. And this one here has been kind of going sideways. Where did we end up on Dave? So it's got a really good discount. But the thing that was a little concerning about Dave is if they stop growing, similar sentiment around some of these other stocks like HIMS is as soon as this slower growth is forecasted, the stock could begin to really have problems. Investors are not as excited. And if we have stocks that just have really good continued growth, like Mercado Libre had good growth, that stock could perform for a long time. So this one here may hit a wall, but they can break through that wall if they just figure out how to grow faster. This is an exciting stock, really worth watching. Let's take a look at Marvell. So Marvell, did I get it right? So MRVL, what am I doing wrong here? There we go. So Marvell, over the last year, it really saw its stock price go down. I think there was a couple of quarters where it didn't do as well as the market expected it to. So the market really sold off the stock. This is a stock that sells into the data center and data infrastructure, semiconductor solutions. So this is in a very, very prosperous part of the market. $74 billion market cap. Forward P is 28. And analysts think there's a discount available. looking at their growth, a surprise is Marvell is participating in the most, the hottest part of the market, the data center, and they're growing by 4.7%. That doesn't fit with the picture. Like, you're supposed to be growing by 50%. Why are you only growing by 4.7? And then in the previous year, they have a year that ends like in 25. It ended on February 1st, February 3rd for 24. Again, during the year that they closed here, the data center was really ramping up. So why are they not growing? So that was a surprise. The last quarter, they did grow really fast, and they did grow really fast the previous quarter. They just had some quarters that have been bad. I think I'm not quite sure why the stock sold off earlier in the year if they're growing by these rates. Interesting. Okay. So if their growth really cranks up, this might be a good opportunity. Their free cash flow is cranking up. That looks good. So their margins are decent, okay, 47.5, not as great as NVIDIA. They're losing a little money, but they are generating cash flow. Okay. So these guys, I don't think they have a debt problem. Let me double check. They have $4.78 billion of debt. They have 1.2 of cash. Debt to EBITDA. They don't have a debt problem. Okay. All right. So we're good there. Forecast. So there is a broad range of price targets. You have some analysts are saying $67 a share, some at $149. And we have a lot of analysts participating in their forecast. And so this is interesting because the year we're in is going to end here. Very good growth. And the forecast for this year is really bad. They're supposed to not grow. So these guys are like very cyclical. They grow, they grow, they contract. They grow, they contract. They grow, they contract. So that is part of the, you got to think about that, because if they do hit this slow growth phase, that's why investors were so darn nervous and sold off the stock. So this forecast is concerning to me. So how could I grow this business? So next year they're going to be 8.3 billion. They're going to grow by 16%. Okay. Now I did my own valuation on Marvell, and I get to a 12% premium, and my growth rate is wrong. Yeah. So let me take a look at some numbers, make sure everything's correct. And the free cash flow is overstated there. Last time I updated was in August, so I just noted the most recent numbers. Okay, so when we update this guy, we're going to go by, just increase it by 20%. They are growing well. All right. These numbers look all right. And yeah, it's priced 36% too high based on cash flow. And when we look at the forecast for earnings per share, it's supposed to be so I'm going to use the next full year. That's going to be $3.44. This is the year that we're in. It's supposed to end March 31st. Okay, yeah, I'll use next year. So I agree with the analyst. I'm with the analyst when we price the stock just using earnings per share. But this is the number that is more important to me. Their value based on the free cash flow they're going to produce. And that is underwater. So this stock is priced 20% too high. This is a sell. It's not a good opportunity for me. I'd rather buy NVIDIA, which was sold off recently. We know what we get in NVIDIA. I have Astera Labs. I've done really well with Astera Labs. And I'm buying into TSM. That has very good pricing. Marvell would be a sell. It's it also, the forecast is spooky. It's like grows, contracts, goes. It's like, geez, man, at any minute they could surprise the investor and the stock would really sell off. All right, we've covered a lot of ground. We've gone over 7+ stocks. Let's take a look there. So Shark Ninja, huh? Another stock might be Shark Ninja. And I'm not familiar with Shark Ninja. I don't know that I've ever covered it. I know they're a consumer-based company. They do a lot of products that, people need it for their kitchens and vacuums, that kind of thing. Year to date's flat, 5-year, done really well. I think it grew really nicely here. And it looks like if we go 5-year, that means that they IPO'd in 2023. Okay. 13.3 billion, revenue is 6 billion. PEs look okay. Discounted according to analysts. Hasn't done much. And looking at their forecast, how are they growing? So they're growing double digit for 2026, close to 10%, 4%. Okay. Now these companies, I'll be curious to look at the margins. I'm going to go with trailing 12 months. So gross margins are good. It's good business. They're growing well. Balance sheet. Yeah, I don't think they have a debt problem. Looks good. Looks real good. Now, if I look at their free cash flow and I multiply it times 15, which is what I would do on a stock like this, yeah, 409 million times 15, that would be 6 billion in value. They had a little bit of debt. So, yeah, they're priced too high. They don't generate enough cash to make up this market cap. Now, they did impress the market by growing, and the market likes growth, but now it's been just going sideways because it just does not generate enough cash to get to this market cap. I think that's the problem with Shark Ninja. And that's not going to change until they get much bigger or the stock price really comes down. The stock's worth like 6 billion in market cap, roughly, and it's priced way too high, in my opinion. DJ, thanks for becoming a member. Thank you, sir. All right. So we covered 7 stocks. Let me take a look at where the market's at. Now, one question I was asked early was, what am I going to buy today? So let's take a look at my portfolio and see what's been going up and what's been going down. Let's start with what's been going up. Oscar Health, beautiful. Robinhood, AppLovin. I think Mike, who brought up, so AppLovin came up last night in our stream, and I think because we were talking about a smaller player in this space, and who was that smaller player? It was No, not Remitly. Mountain, MNTN. They're in the same space as AppLovin, but they're smaller and they're not growing as fast as AppLovin. So I'd rather go with AppLovin. It's a bigger name and so forth. ASML going up nicely. Okay, good. Novo Nordisk, look at that, going up nicely. Target, believe it or not, I'm very optimistic that Target's going to be a really good stock. eToro, I put that one out there last night. Looks like so far so good. All right, so we saw the winners. Now let's take a look at the losers. Oh, hit the wrong button. All right, so Intuit has been a stock I've been accumulating shares into. It's down 0.29. Buy. I'll buy some Salesforce. I'm holding on Catalyst Pharma. I've got a nice gain. I'll buy some Fortinet, cybersecurity. I'm holding on Wix. The market does not like Wix, doesn't like it. It's a discounted stock, but geez, it's just gotten shellacked this year. I own a small position there. I will buy into Google Alphabet. It's still discounted in my book by 24%, and I'm good with that. Reddit is discounted. I will buy more Reddit. It's been flourishing lately. I'm buying into Airbnb. I am buying into, now I'm not buying Zoom. Yesterday I sold 20% of my Zoom position when they rallied higher. They are highly discounted, but the market doesn't care about them. And I've been in the Zoom stock for a couple of years. And at some point I got to fish or cut bait. So I cut 20% of the bait and lowered the position on it. I'm not buying any more shares. Adobe, I'll buy some more shares in Adobe. United Therapeutics, I'm doing well with. Got a big position, not buying any more shares. I will buy more Procter & Gamble, nice safe stock. I'm holding on 3M. So my portfolio is doing pretty good today. I've got a couple losers, a couple things coming down. Looks like our friends over at Meta are doing well today, or doing okay. I don't think they're doing great. But Meta, I think, is a good opportunity. I'll buy some more Meta today. Looks good. All right, go Oscar Health. Let's see. We've got Oscar Health leading all stocks in my portfolio. Robinhood has just been an awesome stock. AppLovin, Novo Nordisk, EQT, they do natural gas, pretty much exclusively natural gas, which is why I've been accumulating that stock. ASML, Semiconductor, and Mark Stan, I am buying Adobe. Adobe is so discounted. It's crazy. Bo, thank you, sir. Chime versus SoFi. We have a cage match, an ultimate fighting in the octagon match between Chime and SoFi. Let's see how that turns out. That'd be excellent to take a look at. Let's take a look at that next. And that's what's going on. So answering the question that was posed early, those are the stocks I'm buying are the ones that are pulling back. And I'm probably going to wait till the last hour of trading today and put in my buy orders then. The market seems to be just, modest gains. And I'd hate to see a pullback and then be a little too early in putting my buy orders in. So I'll put them in probably 2 hours before the market closes, an hour before the market closes, around then. So, okay, now let's get into the Chime versus SoFi compare. Thanks, Bo, for sponsoring this. Let's take a look. All right. So Mark, to become a member is easy. I think I put a link. Let me put it on there again and make it super easy for you. And then I'll get into Chime versus. Here you go, sir. I just chatted how you can become a member. Thanks so much for your super chats. It'd be awesome to have you as a member. And hopefully you can attend member calls and we can talk stocks and figure out how we can invest better together. All right. So SoFi. SoFi is a new generation financial services company. They are fairly popular here in the US. Stock has been flourishing. Now, it hasn't been a perfect situation with the stock. A lot of stocks when they IPO, they have this type of sell-off. Market is too enthusiastic. They look at the fundamentals and they're like, whoa, this thing needs a little more time to become profitable and so forth. And then at a certain point, it's a great buy. I know some people own it in the community, and I don't. I own Robinhood, and but those that own SoFi have been doing really well. So congratulations. Market cap 34 billion, revenue of 3.29 billion. P ratio is a little high. Okay. Now, SoFi, I believe, is treated as a bank. And as soon as you start seeing this net interest income, net interest margin, it's being treated as a bank. And banks, I don't value using cash flow. It wouldn't be correct. It'd be incorrect. So I use a couple of things to gauge if it's a good investment. First is you value it using earnings per share because the market's going to do that. Second, you look at their book value. Banks are valued using their book value. JP Morgan is the most valuable bank in the market, and their book value has been increasing, but their price to book ratio is really expensive. So here we look at book value per share for SoFi. Nicely done. They've gone from $5.36 a couple years ago, 2 years ago, up to $7.29. Nice work. That's a nice job. Very good. Very good. And so that looks good. All right, Mark Stan. Thanks for becoming a member. Appreciate that. So their book value grew. That looks really good. I have a valuation on SoFi. We'll get to it in a little bit. Let's see what other analysts are saying about SoFi. 15 analysts cover SoFi, and we have disagreement on what this stock is priced at or should be priced at. Some analysts are like, this thing's worth $12. Some analysts are like, nope, it's worth 37. So that's interesting that you have a wide range of price targets. To me, when I see this, it takes away confidence level, right? If you had like 40 analysts and they all were like, hey, this thing's worth $25 to $40 a share, you're like, whoa, okay, that's pretty solid. Everybody's kind of somewhat agreeing by being closely bunched together with their price targets. That's not the case with SoFi. Okay, so looking at their forecast, we've got revenue has been growing really well at SoFi, especially in 2025. And it's going to continue to be really good in 26, 27, and kind of slow down in 28. Okay. Now, this one here, only 3 analysts are weighing in. It might be a little too early to tell there. I don't see why they would slow down so much, considering that they're doing financial services and they continue to attract more and more new customers. They have profitability now, and they're going to grow those profits. The next full year, 61 cents per share. And they have a good growth rate. So they probably deserve, I would give them a PE ratio of 25. These high PE ratios are, for if they were growing at 50%, yeah, give them a 40, give them a 50. Yeah, cool. But 20% on a relatively small number within banking. I'm not crazy about it. I'm respectful. Hey, they're growing, great, but I'm not crazy about them. So I'm gonna look for price to book here. That's one of the valuations. So price to book ratio 3.89. Now, I cover a number of banks. I own Citibank as an example, and I cover a number of banks. I actually have done banking stocks like reviews for the channel, and probably the ideal price to book would be 1.25. These guys are way above it. You want to be as low as possible on price to book ratio, but they are growing. They're growing much faster than a typical bank. But it just shows that it is an expensive valuation if you compared them to either a regional bank or a big bank like JP Morgan. JP Morgan's like 2.7 and Citibank is like below 1, which is great. That's the stock that I'm in. Done great with it. Not as great as like the appreciation on SoFi this year, but SoFi is also much more risky. Okay, so we've got that kind of in order, and their growth is good. Now let's take a look at their valuation. So I think SoFi is priced 29% too high. It's done really well, but I think the stock price has gone up a little too high. Now, I was asked to compare SoFi against Chime, and look what's directly below it. Chime. Whew. Lucky. Now, Chime, I guess I'm revealing my price target, is priced way too high. Let's see why I think that way and see if I'm going to change that number at all. So what does Chime do? Let's take a look. Chime Financial, a financial technology company, provides digital consumer banking and payment solutions. It offers Chime, a banking application for providing mobile banking services that address the need of people such as their spending, saving, accessing liquidity, building credit, savings, perks. Okay. All right. So that's where we're at. And I think Chime is a new issuance. It's a new IPO. So here it is. IPO June 12th. Most IPOs do this. They come out, there's enthusiasm, they're priced up here, they sell off. And over time, because remember SoFi, enthusiasm, sell off, rally. And if we saw 100 stocks that IPO'd recently, you'd see very strong similarities. So that's what we're dealing with here is a recent IPO. Market cap 7.45 billion, so it's smaller than SoFi. Revenue 2.08. Okay. And they're not being treated as bank from stock analysis. They're treated as a they charge per transaction. They're not trying to charge interest and borrow money. They're borrowing money by depositors, right? Like a bank will have its depositors bring in money and then they'll lend it out to somebody else at a higher interest rate than they're paying. These guys are more transaction based. They charge per transaction, almost like a Visa. Visa charges, in general, there's 3% that's being charged on a transaction. That's divvied up between Visa and whoever issued the card, like whoever the issuer was. Okay, so that's a difference in how they're treated. Chime, we have again a broad range of price targets. We have 13 analysts weighing in, and you have analysts saying this thing's worth 40. Some analysts saying it's worth 17. But there is a big discount available. Okay. Let's take a look at their forecasts and what they're supposed to do. So we're in this year here. We have 11 analysts covering them, saying they're going to grow at 20%. SoFi is growing at 20%. SoFi is bigger. So right now, SoFi is looking better on their forecast. And then they're going to grow at 17. Again, SoFi is looking better. They're supposed to grow faster in the outer year. So this one here looks more expensive, inferior to SoFi based on their forecast. SoFi is going to grow better, and SoFi is larger already, and they're going to grow at a faster rate. SoFi wins that category or that metric. Chime it's too early after their IPO. That's one thing that I'd be very concerned about. I wouldn't touch Chime. It'd be a sell. It's priced too high. Now, the stock that I would put into the mix would be Dave. Dave, I think, could be a stock that is not exactly SoFi, but similar. Not exactly Chime, but similar. Dave has better numbers. If you want a high-risk stock, because Chime is a high-risk stock. SoFi is risky, but not high risk. Dave is a risk stock. I think Dave is a better option. If I was forced to buy a stock in this category, I would buy Dave. Let me think, make sure I cover this. Domestically in the US, I would buy Dave. That would be my shot. So thanks for asking about that. It looks like SoFi and Chime went into the octagon, and SoFi has won by unanimous decision. SoFi wins the selection between those two, Chime and SoFi. I wouldn't buy either. Some other investors in this community have made a lot of money on SoFi. Congratulations. If you were forced to buy one or the other, it would be SoFi. If I was forced to buy a stock, I'd buy Dave in this category. I don't own Dave. I'm not ready to buy Dave, but that's what I would do. And good luck with your decision. Thanks for asking. All right. So again, Mark, Stan, thanks for joining. Before I forget, email me, and the two members that came on, email me at victorhinvesting@gmail. And I'm going to set you up with your perks. So perks, like if you become an advanced member, you get access to the model that I use. You get invited to the member calls. You get access to my research. I copy like all those valuations and I put them in a shared folder. You get access as an advanced member to the Discord. So both members, please email me. I want to make sure that you get every perk that you're entitled to. And I put my email on the last chat message, and it'd be great to get you guys hooked up and involved. Thanks again for becoming members. Mark Stans. So I think NU has better fundamentals. So New Holdings. Yeah, I like New Holdings. I'm buying into New Holdings. What do I like about New Holdings? I like their growth. Now, these guys are international play. They're in Brazil, doing business in Mexico, Colombia, Cayman Islands, and so forth. So out of the gates, a little more riskier, but it is a pretty good cap, 82 billion. Very well-known stock. A lot of people know about it. P ratio of 33. So I think when you look at their growth, it's reasonable. Forward P 22, fairly priced. Over the 1 year, up 20%. Over the 5 year, up 89.89. Quarterly, 36% growth in the last quarter. They did kind of hit a slow period here, which created a lower price in their stock. But now they're beginning to really catch a good momentum swing and is doing well. They've been a good growth company, and overall their growth looks really good. So this one here is a stock that I'm buying into. You got 10 analysts covering it. There is a difference in opinion on what this thing's worth. They think it's priced a little too high. It has caught a recent rally, And this one here is supposed to keep growing 23%, 24%. This growth is better than Chime and I think better than SoFi, but it's international, right? It's higher risk for a US investor and it's going to expand their profits quite nicely. So I do agree that New Holdings is pretty solid enough to make me want to buy shares, and I've bought into New Holdings. I've bought into New Holdings on, this is going to be the second occasion. I think it's discounted by 37%. And the first occasion I made money, sold, came back. Now I'm buying in again, and I think it's a good idea. I think the Latin American economy is growing well. Countries like Colombia are doing well. Mexico is doing well. Brazil, I think, is getting stabilized. And there's just a lot of good organic growth available in that region. So I agree with you. So trading stops early today. Thanks for the tip. I got to check in on what are the trading hours today. I thought Friday was going to close early, but I thought today was normal. So it's closed tomorrow, and then Friday I thought had the limited hours. I'm going to double check that. Thanks for the tip. All right. So okay, cool. So we've covered a good number of stocks. We covered 9 stocks. Good stuff. Got some people to become members. Thank you. Again, email me so I can get you set up on your perks. And hopefully you can attend some member calls, join the Discord and all that good stuff. So thank you. All right. So where are we at with this market here? So we've got semiconductors just still doing well. Google still gave up some of its excellent gains recently. No big deal. Okay. So we got a mostly winners, mixed market, but mostly winners. And let's take a look at where the exchange is at. So we're up 0.53%. So good. Man, these are 3 good days. We had update on Monday, update yesterday, and we're going to have an update today if things hang on to where they're at. And bear with me here. All right. And I see your comment on BNPL, and I'm going to get to that in 1 second. Okay. All right. So what do you think of BNPL companies like Sezzle and Klarna? So I looked at both recently. Probably the one that I know I looked at recently was Klarna. So this is Klarna Group. This is a new IPO, by the way. They IPO'd September. So these guys are a payments company in Europe. Okay. And the payment space is a little crowded. This stock hasn't performed all that great after their IPO. And there's an $11.77 billion market cap. Revenues 3.2. Forward P is really high, 124. Their growth, looking at that PE ratio, it's like really high. Now, the recent quarter looks good, but some of these other quarters don't look good. And the annual doesn't look great. This is just okay growth. It's not like, wow, incredible growth. So it's good growth. How many analysts cover this? 14 analysts cover this stock. They think it's discounted by 51%. These guys are very high on the company. I wonder why. Are they supposed to start really growing fast? So 29%. That's good growth this coming year, 2026, and then 2027. It's not incredible growth, but it's good growth for a small business. So that looks okay. I think I have a valuation on Klarna. Yeah, based on cash flows, it's very early, but Klarna does have a nice discount available on cash flows. Klarna would be this is a risky stock because it's so early in their IPO. And this is why it's risky is there's no track record. They just started to announce their earnings and their results publicly. Could they surprise us in a quarter, 2 quarters, 3 quarters, and then the stock crashes? Yes, that's why it's riskier. Could it also surprise us and be the next Robinhood or the next Palantir or the next, really high flying stock? Absolutely. But it could go in one direction or the other. It could really go up high, or it could really go down low, or it could go sideways. And that's based on your risk, your level of risk tolerance and how you like to invest. That's your option here. But the cash flows for Klarna show this company is going to be worth something. And I give it a very high discount rate because I just told you it's risky. And it's still discounted by 57%. Revisiting where these analysts are, they're at 51% discount. So that's 14 analysts putting their opinion out there. And that's where I'm at with Klarna. It's not a bad idea. I'm beginning to think maybe I got to think about Klarna. But these small caps, man, they could really go down in price fast. So you mentioned Klarna and Sezzle. So Sezzle, Sezzle. So Sezzle's been around a while. It's not doing well for the 1 year. The compare is really interesting. And then for the year to date, it's doing well. It's a $2 billion market cap company, $418 million in revenue, and PE 17.6, forward P 13.6. These look pretty low, really discounted according to the analyst. So Sezzle operates as a technology-enabled payments company primarily in the United States and Canada. Okay. So very similar to Klarna. And they have been growing quite nicely historically, and they continue to grow. Now they're small, but they're growing fast. That looks good. So growth is very good. Analysts are high on the stock. I think they really like that growth. 4 analysts cover it. Not a lot of analysts, but the analysts that do cover it, some of them are very high on the stock. Then we've got this year, they're growing really fast. They're going to continue to grow at 27, 31. Those are good growth numbers, very good growth numbers. And their PE ratio is really dropping. This is looking like a really good stock. This one looks real good. So that looks good. I'm pretty sure their balance sheet's okay. Yeah, they have almost as much cash as debt. So we're good. All right, so Sezzle. I wonder if I have Sezzle. So what's going on with Sezzle? So their cash flow isn't great. Let me update the cash flow there. Maybe I see that this valuation's a little dated. So trailing 12 months is 55 million. So Sezzle's small. They've been around for a little while. They've got more of a track record. Cash and debt was a little different than this. Let me update that. So they're a little pricey because their cash flow isn't really hitting a high margin, a high amount. Looking at their earnings per share for 2026, 435. They are going to grow. That's fine. Growth rate. That's fine. Okay. So they do have a nice discount on. So the difference between Sezzle and Klarna is cash flow. Let's take a closer look at Sezzle. What's going on with their cash flow? So we have, here's their annual. Let's go trailing 12 months. So here's your cash flow. And they've been around for a while. These guys have been around. Yeah, the cash flow looks consistent with a payment company. And that's those numbers look accurate. Now looking at Klarna. So I'm looking at US dollars. So US dollars trailing 12 months. This number looks too high, 1539. Yeah, the cash flow for Klarna is really high. Let me double check their website. See if I can look at their. So here's their earnings release financial reports. Here we go. So, okay, total revenue. Yeah, they're including consumer deposits. And I wouldn't do that. So they are increasing cash flow really fast. But those are deposits from the consumer. It's almost like a liability. This is a company out of Europe, and it may be the way that you report in Europe is a little different, but like they have their bonds here. This should be down here in investing activities. Operating activities should be purely you're operating the business. And in their case, the transactions are doing, but to put in things that really should be in the investing category kind of muddies the water a bit. So that is something that I wouldn't have done it that way. That takes away a lot of the cash flow. That's part of, these guys are a new IPO. And I think I would give Klarna a solid year of being public before I even got anywhere near being serious in investing, even though it has some promise. Sezzle has a small discount. It shows some promise. Year to date, it's done okay, but it's had its ups and downs. So these are risky stocks. Yep. I'm not confident in either now. I wouldn't invest in either. I'd give it some time on Klarna. I don't like the way they reported their free cash flow. They shouldn't be putting in borrowings, deposits, treasury bills. That should be down here. But that's the way they did it. So that's Klarna, Sezzle. Sorry, I couldn't be super clear on those, but my confidence isn't really high if it's not showing on both of those. I'd have to give them some more time. It'd be too risky. Companies like New Holdings, they've been around for a while. They have a track record. They also have a track record of going up in value for the investor. That's what you get with a company that's been around for a while. Here's a comment on it. So okay. Hey James, good to see you. So it's 1400 Eastern time. I'm not sure I follow that comment. All right, so let's keep going here. So I think I'm a little behind here. So we left off on Sezzle versus Klarna. Hopefully you found my analysis interesting, and I couldn't arrive to a solid ground on those. And that's because Klarna is so new. The way they report, it's a little out of sorts. But hopefully you found my analysis interesting. Mike. So I have been buying Instacart. It has been working recently. The market's funny, oh, Amazon's going to take these guys out. Stock sells off. They come out with their earnings. Earnings were great. Stock rallies higher. And you have stories, right? Which, the story kind of holds water, which is, well, Amazon, if they enter in the food delivery business, that's going to be a big competitor against Maple Bear. Yeah, but the delivering groceries is, I think you have to specialize in that to some extent because it's groceries. It's a perishable. You don't want, speaking for myself, I don't want, like, let's say I ordered milk to be sitting in somebody's van for 3 hours. Yeah, great. So I think Instacart has a very good place in the market, and they've been growing well. Their earnings were good. Their forecasts were solid, and the stock really rallied higher. So I'm glad that I was buying into it. It's beginning to really work, and I have a nice discount on Maple Bear. So That's been one that's been working. Really nice discount. And I know we just looked at some really risky stocks, Klarna and Sezzle and so forth. You can find really good discounts in stocks that we can really get our heads around. Maple Bear, discounted because the market believed the story that Amazon's going to take these guys out. And you have to make the decision. Do I believe the story, or do I look at the evidence in front of me, which is good revenue growth? They have a business model that's very specific to grocery delivery. And that's what I decided to do. And it's working out for me. Meanwhile, I'm an Amazon stockholder. It's not like I'm saying Amazon's bad. It's just Amazon's not going to do all things for everyone. Yeah, I agree. App loving, volatility is my friend. I don't see why people dislike volatility. Volatility enables me to buy app loving and then watch those dollars increase in value, that capital increase in value. So app lovin's been on a tear. You keep going, app loving. Just a 5-day up 12%. And these guys are growing really fast, which is phenomenal. Big House, good to see you. VG, what is VG? Venture Global engages in the development, construction, and production of natural gas liquefaction export projects. Oh, so this is similar to EQT. Very good. Good idea. But this is midstream. So their development, construction, production. Okay. Yeah, they're doing natural gas. I'm thinking natural gas is a good play because the data centers are going to need a lot of natural gas to produce that power they need. And this one's really sold off. This is a new issuance. Yeah, January 24th, 2025. Market cap 17.36. Low PEs. Small dividend. So this is going to go where natural gas prices go. So that's why the numbers are going to look rough. Although, man, look at that. Revenue growth really skyrocketed. What's going on with these guys? Let's take a look at their website. So low cost liquid natural gas to the world. Okay. So they're down in Louisiana. Okay. So they're trying to export their product out to the world. Okay. And that makes sense. Okay. Here they signed a deal with Tokyo. Okay. So it's a natural gas play. And depending on where natural gas prices are going, this stock will work or not work. Right now, it's not working for sure. I'm getting into EQT while natural gas prices are low. And it's a good time to think about spaces, sectors, industries that are really sold off. But when things change, they're going to really rally higher because you get good prices on them. Energy tends to be that way. You buy when nobody wants it. And then once it gets going really fast. So that's how I'm playing natural gas. Good to see you, Big House. You're all in with risk. All right. What's my valuation on Procter and Gamble? Procter and Gamble. This is one of the lowest risk stocks an investor can own. 26% discount. You like the highest credit rating you can imagine. These are products that we just consume. Tide detergent, Charmin, tissue. These are just solid, very, very well-run business. You're not going to expand your wealth overnight with this company. It's just going to be a solid dividend payer that is going to really work when everything else comes down. So my discount is 26% on Procter & Gamble. And I think Procter & Gamble's been doing okay over the last month. While stocks have been super high in stock price, right? With, it gave me an opportunity to buy into it and accumulate some shares. Year to date, this thing's down 11.6. It hasn't done great over the 5-year, just up slightly. And I'm just accumulating some safety stocks. Not a big position right now. It's less than 1% of my portfolio. It's small. And I'm also accumulating Colgate-Palmolive. I already have a lot of Kroger, which is a staple, consumer staple stock. And these guys pay a dividend, 2.85%. Procter & Gamble. I am on the app love and train, not getting off, adding shares when the market allows me to. Good to see you, James. Yeah, okay. I'm glad we're on the same page with the hours. Today I think is normal. Friday is when we close early. All right. And that's what James was telling me. We're going to close at 1400 Eastern. Got it. Okay. It's all coming together for me. Thank you, sir. Appreciate you being a member now. Got it. So they lost a lawsuit. So they're going to have to pay out some money. All right, guys. So we just covered a good number of stocks. I think we covered well over 10 stocks. And blocks for fun, if you're still out there, I'm going to email you explaining why I couldn't cover a stock you asked for. And just taking a look at the market, we are going higher, folks. That is okay with me. This market does not know how to sell off and correct. It went down 5%, and I wonder if we're back. Are we back to where we were before? We were here on the high on 28th. We were at 68.90. We're at 68.17. This market doesn't like to go down. But it's healthy to see that 5% pullback, because at least some of these really expensive stocks saw their stock prices come down. And that seems like a healthy thing. NVIDIA, awesome business, came down. And I could go down the list of some stocks that prices came down. Meta came down. Okay. So it offers us a better entry point into these awesome businesses. So it's a good thing. But the market just doesn't, it's not like 2022 where we went down. We kept going down for like a year. It was like, oh my God, when's this thing going to end? It was like death by 10,000 paper cuts. So that's where we're at. We're almost back to where we started late last week. We'll see where we go from here. The heat map is looking pretty green. Google's still giving up some of its gains, but that's all right. It's still flying, doing great. NVIDIA is back. All right. Walmart, go Walmart. I am buying I think I told you Target. How's Target doing today? Target's the good deal in that category. 385. All right. Target was kind of like the conclusion on a stock that a video I created for the channel where I compared all the retail companies. And this stock came out of that research. And I'm thinking, this is the right stock for me. And it's been doing well over the 5-day, pays a 5% dividend. This thing's beaten down. It is beaten down 50% over the 5-year. And they're expecting to start growing. And I think that's If they do this, if they start to grow, the stock's going to double quickly. That's why I'm buying into it. And this is a nice, boring retail stock. They have good margins. Walmart's been flourishing, and Walmart's growing by about the rate that these guys are going to start growing in the future. So it's fun to do analysis and kind of find a diamond that's roughed up, maybe has a lot of mud on it. You need to wipe away the mud and see what you're looking at. Hey, man, this is pretty good. What's my valuation on target? Let's take a look at that. Oh, there's a lot of targets out there. There we go. 33%. 33% discount on target. I use a higher discount rate on it since they've had some troubles. But you're going to pay me 5% dividend, and I'm going to have some upside. Where do I sign? And you're going to grow your revenue in the forecast in the future. See how many analysts are putting their good name behind their forecast on target. 41 analysts, 22 analysts. So we're not talking like 2 analysts. We're talking a lot of analysts are saying they're going to start to grow. And in this space where you have these big businesses, a little bit of growth goes a long way to get enthusiasm up. So that's a stock that I would say I'll skip on Walmart. That's priced way too high. I'll go to Target. So Zscaler's getting hammered. Wow. So, I made money on Zscaler. Let's take a look at the 5-year, and I'll tell you how I played Zscaler, what I saw, how I took advantage of it, and how I got out. Sometimes you get in and out of a stock and you're like, oh man, I should have stayed longer. But so Zscaler in this era was really being counted out. Like, oh man, it's CrowdStrike is the best stock in the universe. And I thought, no, I'm going to buy this stock. And it had very good fundamentals. I took it up for a ride. I sold it. And since then, it hasn't been doing great. When we look at what's doing today, 9.69, it announced their earnings yesterday. What did they announce? So the revenue looks okay. They probably guided and said, we're not going to smash the number next year. And the market's like, oh man, we're going to sell you off. Fundamentals were good last time I looked at them. I haven't looked at their earnings. Gross margins, very good, 76%. Free cash flow margin, excellent, 32%. They don't have a debt problem. What's going on with the forecast? We have 33 analysts covering it. They think it's discounted. And I switched horses. I sold Zscaler and I started buying a Fortinet. Fortinet is being counted out, discounted really well. And so far, I don't think I can claim that I'm doing well with Fortinet, but I'm glad I'm not in Zscaler anymore because it seems like it's given up a lot of its stock price. And Zscaler, when I go through the valuation, this is a little dated, but the numbers are consistent with what they were doing before. So I think the valuation is going to be accurate. I think they're priced 19% too high. And when I started buying into it and I made a good return on Zscaler, they were discounted like 35, 40%. Started buying into them, wrote it up, and then sold them, and then started getting into Fortinet. I think Fortinet provides a really good, strong proposition. I'll buy into it. Hopefully I could replicate what I did with Zscaler and call it a day. Thanks for the tip there, Mike. So that's that. Okay, cool. All right, guys. Well, let's end it there. Everybody, that's going to be my stream for this morning. Thanks for tuning in. I appreciate it. I appreciate all the comments, all the requests. We got 2 new members on the stream. That's awesome. We've got some super chats. Thank you. And I hope you found the analysis interesting. I'm not going to be streaming tomorrow. Might release a video or 2 that I'll schedule. But tomorrow is going to be Thanksgiving. Let me wish you all a very happy Thanksgiving. hope you have a terrific day with family, friends, whatever you're going to do. I know I'm going to enjoy the time with some people that I don't see often enough. Everybody's so busy, which is great. We get to do stuff that we're interested in, but it's good to slow down for a day, hang out with people I care about, see them, and especially the little kids and the elders of our family. I like hanging out with them. So everybody enjoy your Thanksgiving. Thanks for tuning in. It was a good session, and I'll be streaming again on Friday morning, same time, 9 a.m. Eastern, and we'll go for a couple hours, look at some stocks. Come back if there's some stocks you want to research together. We'll do it on Friday, and I'll try to stream again in the evening. The evening stream was excellent, as was this stream. And I'd like to do that again. I don't know if I'm going to be able to do it tonight or if I'm going to be able to do it Friday. We'll see what works, and we'll go from there. All right, everybody. Enjoy your day. Take care. We'll see you.